Good afternoon, ladies and gentlemen. Welcome to Business Today Television and our special show, Market Masters. Today we have a special guest for you, the ever-smiling Saurabh Mukherjea. He's the CEO and founder of Marcellus Portfolio Management Services, which over the last 5 years is perhaps India's most well-known and widely reported portfolio management services provider. Welcome, Saurabh, to Market Masters. This is me, Shail, and with me is Sakshi Batra on this show. It's such a pleasure to host you.
Thank you. Thank you for having me on the show.
Okay. And, I seldom prepare notes, but since you have come on our show for the first time, I've made copious details on what I'm going to ask you. And it's going to be a very enjoyable 45 minutes, ladies and gentlemen. And this Market Masters will actually focus on Saurabh's main talent, that is picking up and understanding highly valued companies and how to keep multi-baggers in your portfolio. Saurabh is an amazing individual. Over the past 5 years, of course, like I said, he's set up Marcellus Capital Management. And before that, he was the CEO of institutional equities at Ambit Capital, where he spent about 8 years. Before that, he was with the Nobel Group for 7 years. And prior to Nobel, he spent 3 years in the world of consulting with Accenture. Apart from that, Saurabh is a Master's in Science for Economics. That's from London School of Economics. And if this is not enough, he's a very well-known and widely read author of investment books, which I believe now are meant for people to study even in their MBA schools and colleges. Saurabh, with that introduction, welcome once again to Market Masters. And today we'll be spending the next 40-45 minutes on understanding your brain. That is, how you pick up stocks, what prompts you to avoid certain sectors, and of course, what is the reason behind the wonderful performance that such stocks like Asian Paints, like HDFC Bank generate over the longer term. With that, let's start with the first question, which is, let's start with what you avoid completely. What are the 2 or 3 things that don't fall in your valuation matrix, which you avoid like plague and you won't touch with a barge pole?
Sure. Marcellus, thank you for having me on the show. The 3 things that we avoid. The first is companies where our forensic accounting is showing that the promoter is doing naughty things with the account. So we have around 18 forensic accountants in the firm. Most of these are people that I've hired and trained over the last 15 years or so, the 15 years that I've lived in India. And roughly, if you look at the BSE 500, there'll be around 200 companies where our forensic accounting research is showing that these companies, the promoter is pilfering money from the books, and we'll stay out from those companies, stay away from those companies. Second is companies in sectors where there is very high requirement for governmental sign-off. So for example, if you take real estate, say to put up a 5-star hotel in any major city in India, you need 60 layers of governmental sign-offs, right? And typically that sort of governmental sign-off process, whether it's in real estate or metals or mining or power and infrastructure, that tends to deplete the company's ability to generate high profits. So we stay away from those sectors. And the third area is sectors where we have seen historically companies have struggled to make money. This could be because of very high capital requirements or delays in customers, typically government-related customers paying the company. So PSUs generally is one such problematic area. PSUs by themselves, there's nothing wrong with them, but often the PSUs tend to make very high capex investments where the returns are uncertain, typically don't fructify, and often the PSUs also struggle to get paid by other arms of the government. And therefore, these are the 3 buckets where we avoid companies. 1, naughty accounting; 2, lots of governmental sign-offs; and 3, PSUs or companies which are typically paid by the government and therefore tend to struggle to collect money.
Fair. So that leaves you with probably 200, 250 companies in India's most widely tracked index, which is the Bombay Stock Exchange 500 or the Nifty 500, as you may want to understand it. Saurabh, now let's come to the facts that attract you into actually creating a catchment of companies which you will first track and then maybe invest in. So, what are the three or
Sure.
four things that you look into a company before committing shareholder funds?
Sure. So the first thing, obviously, look for clean accounting. So that's there'll be roughly 300 companies in the BSE 500 where we reckon the accounts are believable, they are solid. Secondly, over and above clean accounts, we want to see a track record of the company generating a return on capital. Pre-tax return on capital should be a minimum of 15%, because if pre-tax is 15, that means post-tax return on capital is 12, 13%. And that suggests that the company can actually make money for itself. If it can make money for itself, then it can make money for shareholders, your viewers, my clients, and so on. So that's the second criteria. If you apply the second criteria to the BSE 500 shell, you're left with roughly 50 companies, 50 companies out of the BSE 500, where books are clean. And secondly, return on capital, pre-tax ROC is consistently above 15%. The final criteria, which takes us from 50 to roughly 15, 1 5, which takes us from 50 to 1 5, is we want the company to have dominance in a specific sector of the economy. We want it to have pricing power. We want the company to be able to charge 20, 30% extra compared to competitors without the customer having any problem with that premium pricing, right? And that premium pricing combined with good accounts and good ROC is what we look for. That's the holy trinity of investing as per Marcellus.
Fine. At the moment, we've narrowed down to 50 and then to 15. Now, let's drill down further, Saurabh. You have these 15 in front of you. Now, the problem starts that these 15 are also known to other portfolio managers and have, of course, already given multi-bagger returns over the past 20, 25 years. How do you reconcile to the fact that you are buying an asset which is very well discovered and probably already pricier based on valuation methods which are normally used on Dalal Street?
Sure. So if you think about it, Shell, right, the fair value of a company, fair value of any company, whether the company is in Marcellus's portfolio or isn't, the fair value of the company depends on how many years into the future this company will do well. So just to sort of give broad ballpark numbers, if a company grows at 20, 25% for the next 5 years, after that, the growth goes down to as low as say 5%. So 5 years of great growth. I mean, after that, growth goes kaput. On a basic DCF valuation, on a basic Excel DCF valuation, fair value PE shouldn't be more than 25. Fair value PE shouldn't be more than 25, right? So 5 years of strong growth followed by very little growth thereafter. 25 PE is the maximum we should be willing to pay. If, on the other hand, the company grows at a strong rate, 20, 25% for the next 20 years, it grows at a strong rate for the next 15, 20 years, and after that, the growth rate drops down to, say, as low as 5%. Then you'll see that fair value PE can be anywhere between 70 to 100 PE, right? And finally, if the company can grow at 25% for 25 years, 25% for 25 years, and then growth drops off, then fair value PE can even be 200 PE. This is basic DCF. 5 years growth, 5 years strong growth, 25 PE. 15 years strong growth, 70 PE. 25 years strong growth, more like 200 PE is warranted. And therefore, our job as an investor is to figure out how long will the company grow at a good rate before growth disappears. And that's where our arbitrage, our strength vis-a-vis other investors comes in. The amount of research we do into the names that we invest in gives us a pretty good idea that this company will grow at, say, 15 years or 20 years before growth comes off. And what we find is in the Indian market, other people don't do this sort of research. They tend to take it as a default that a company will do well for, say, 10 years, and after that, growth will drop off. Whereas the reality in India is roughly 15 to 20 companies in the BSE 500 are capable of growing at a great rate for the next not just 10 years, but more like 20 years. And that's the arbitrage. The market has a less optimistic view of these companies' growth than we do. And that gives us the chance to buy great companies at heavy discounts to fair value.
Right. So I also wanted to ask you, now that we've discovered, how do you identify the companies? The big question where most of the investors get confused is when to buy and when to exit these companies. How do you go about that?
Sure. So the when to buy piece is easier to answer, right? So let's take an example. Say let's take today, right? If we sit down today and we look at say Titan or Asian Paints or Bajaj Finance, these are all stocks that are in our consistent compounders portfolio. Titan, Asian Paints, Bajaj Finance. These are companies in our consistent compounders portfolio. I am invested in the portfolio through our PMS. So are my parents. So are our 10,000 clients. If you look at these companies, the stock market is typically discounting 10 to 15 years of growth, Sakshi. The stock market is saying that 10 से 15 साल, 10 to 15 years, these companies will grow at a great rate. And after that, growth will drop off. Our research is telling us, just to narrow in a specific company, our research is telling us Titan will grow at a rapid clip, not just for the next 10, 15 years, more like for the next 20, 25 years. In the jewelry sector, in the eyewear sector, in expensive sarees, in online jewelry retailing,
Sakshi,
we don't see
take
we
that
don't see
question.
credible we don't see credible competition emerging for the next 15, 20, 25 years. And therefore, what we are getting is we're getting Titan at hefty discounts to fair value, and we are therefore loading up. So that's the first piece, right? You enter when you think the market isn't as bullish about Titan's future as we are. Then the next thing is if the stock price comes under pressure, right? So, for example, last year, 2022 June, I remember Titan fell 25-30%, right? I think the government announced import duties on gold. Titan fell 20-25%. We knew that the government import duty on gold was not going to make a difference to Titan's fortunes. So when Titan's share prices fell by 25-30%, we loaded up further on Titan. So once you've entered, if the stock then cracks, right? Bajaj Finance cracked in March, April, May 2022. It fell by, I think, 65% in the first wave of COVID. We tripled our position. Similarly, in Titan last year, when the stock corrected, you increase the position. And when do you sell? You sell when you start realizing that the future growth prospects of this company are actually inferior to what the market is realizing. So, for example, we sold Relaxo from our mid cap portfolios roughly a year ago, and we sold it because we felt that the market was being over optimistic about Relaxo's growth prospects relative to what we felt the reality was. We had held Relaxo for 4 years. It had doubled, in fact, it had tripled our wealth. The Relaxo promoters had worked very hard to triple our wealth. But through last year, we had reasons to doubt that Relaxo's future was as bright as it once was. And therefore, November, December last year, we exited Relaxo.
Okay, fair enough, and that gives a lot of points for all our viewers to understand, what is the right time to buy and to exit certain stocks where you may be believing that it has definitely given you decadal growth as well. But let's start with our question and answer session from our viewers as well. A lot of questions have come in to us. So let's take the first question that's come in through our WhatsApp number. DS Rajkumari from Bengaluru has asked you this question. I know, and this is a very important question for you because you are a great advocate of the India growth story, and she wants to know from you, in India's growth story right now, which are the factors from outside that it could affect its progress right now?
I think the main bull factor I see in India's growth at the moment is the way China is dismantling its growth story is remarkable. There's a whole bunch of things happening in China. Perhaps we could go into it in some other program, Sakshi. But the dismantling of China's growth story means that in almost every critical sector, whether it is pharmaceuticals, whether it is smartphones, whether it is medical equipment, in every critical sector, there is business that China used to dominate where market share is shifting to India. Now, in most critical sectors, China is 10 times larger than India. So, for example, in active pharmaceutical ingredients production, China is 10x larger than India. What that means is even if India takes 10% of market share from China, our API industry will double in the next 3-4 years. So active pharmaceutical ingredients, China makes $180 billion. We barely make $20 billion. Even if we take $20 billion of share from China, our API industry doubles, and that's why. Last December, we quadrupled our position in Divi's Lab. Divi's Lab is the largest manufacturer of APIs in India. It's the fifth largest in the world, and I think a straightforward beneficiary of the shift in API production from China to India. Similarly, In smartphones, you're seeing this play out with Apple shifting 1/5 of its global production to India. And I think we will hear about this story from many large global companies as they shift their supply chains, such as the colossal scale of China. Even 1/10 moves from China to India. Our several parts of our manufacturing sector will double in the next 3-4 years.
Yeah, right, Saurabh. Coming back to the growth story that we are seeing unfolding in India, you've been here for about 20 odd years, and I have spent a similar amount of time tracking Indian equities. What's really interesting is this time the growth is coming from both ends of the equation, which is the top end of the pyramid, the aspirational theme as we discuss it in the market, and of course the lowest end of the pyramid, which has turned digital with a vengeance. When you look at the top end of the pyramid, say somewhere like, maybe a crore individuals or so who really spend money as if it's coming to an end at the end of this month. How do you reflect that in your portfolio? Because conspicuous consumption in India is staring in your eye. There is a waiting list for every known Mercedes, every known Beamer, any top end car. Real estate is selling like hotcakes. Clothes, etc., are not available at the drop of a hat. How are you reflecting this in your portfolio?
Sure. So Shailji, I think you're absolutely right. The income tax data is leaving us with no doubt that a small category of super rich individuals are seeing incredible jumps in prosperity, right? So, for example, the number of individuals filing income tax returns of crore upwards has doubled in the last 5 years, last 4 years actually, right? And we call this the octopus theme. Roughly 1 million individuals, around 2 lakh families whose wealth has absolutely exploded in the last 4-5 years. And we are playing this through some companies such as Titan is a straightforward example. Titan's Tanishq's revenues are growing at 25%, but Titan's online jewelry arm, Carrot Lane, revenues are growing at 50%. We built a large position in Titan over the last 2-3 years, and as I said, every opportunity if Titan dips, we are adding to that position. Similarly, if I take Royal Enfield, Eicher Motors, that's a company that we have built a small position in, and if there is any weakness in Royal Enfield or Eicher Motors' share prices, we will continue building the position in Eicher Motors. At 2.5 lakhs, Royal Enfield is a straightforward play on aspirational consumption, on high-end consumption. The cheaper motorbike manufacturers, the cheaper two-wheeler manufacturers are growing 1/3 the rate of Royal Enfield. And if you move to, say, financial services, a bank like Kotak Bank, their wealth management arm, their asset management arm is growing at 20-25%. And again, Kotak Bank, therefore, to my mind, becomes a play on this whole rise in super rich. You can see this in small cap stocks as well. So we've recently invested in a hospital chain called Rainbow Hospitals. This is based out of Hyderabad. 17 hospitals spread across the booming cities of South India, which are focusing on maternity care, childbirth, and pediatric care. Right, very high billing rates, very high utilization rates, 45% return on capital, and therefore Rainbow Hospitals. Similarly, Vijaya Diagnostics, a provider of healthcare diagnostics in southern India, another booming healthcare chain down south. So there are several stock market plays which are allowing you to focus on the super rich, and as the super rich get richer, we are making money by loading up on stocks which concentrate on the super rich.
You know what, Saurabh, over the last 3 odd decades, I have personally sold 3 Eicher bikes, the bullets that you talk about. Wow. And each time I pass in front of their showroom, I feel this pain in my heart that I must buy one more. It's the better half at home who prevents these decisions from being taken. But I completely agree with you that
but I
Royal
think buying
Enfield,
an Eicher is much better, than the visuals that were coming over the weekend of people running to buy the Apple iPhone in the malls and reaching there first. I don't know what was the freebie that they were getting in. I mean, it was hilarious to see people running like anything. I'm sure even Saurabh, you would have come
as far as
that.
iPhone 15 is concerned, I'm very conscious about keeping both my kidneys with me. That's the price point. But your
Sure.
point is very well taken, Saurabh. The level of aspirational spending that is happening in India is phenomenal.
Yeah.
And this is only going to grow. So 2 or 3 stocks that Mr. Mukherjee has added to his portfolio. Let me just talk a little bit about the 5 schemes that Marcellus offers. Remember, 11,400 crore rupees of assets are managed under 5 different schemes. Let me just take names: Consistent Compounders, Little Champs, Kings of Capital, Rising Giant, Meritor Q, and of course Global Compounders. Vijaya Diagnostics and Rainbow Children's Medicare that Saurabh just mentioned would probably be in the Little Camps mid cap portfolio.
Absolutely, absolutely. Perfect.
Okay.
Yeah.
Saurabh, let's come back to the theme that you've isolated a company, you've bought into it, and now comes the, the drudgery of it all, holding the investment for a very long period of time. And I quote from your website, which says that investing is like watching paint dry. So, what do you do in this intervening period where Titan may be available at a discount to its fair value now, despite being a record high, but has to be sold 15 years hence?
Sure. So I think broadly 3 sets of activity, Shell, to keep us busy, because there isn't that much buying and selling which actually happens. Once you've identified a great company, you stay invested. I think the first is you try to help the company as best as you can, especially in little champs. Especially in little champs, we sit down with them, we identify what we think are deficiencies in the company. So maybe they need a great CFO, or maybe they need a better chief operating officer. You offer them, assistance in finding a headhunter who can get them a great chief operating officer or a or a head of sales. Second layer of work that we do is helping companies get clarity on corporate strategy. So even with successful investments, we sometimes find that when a company hits, say, 3 billion, $4 billion market cap. 3 billion, 4 billion is a tricky stage, because that's where you're transitioning from small and mid cap to large cap. You're going from being a chota company to a big company. We sit down with them and say that so far you've focused on a specific niche in the economy. You've done really well. But here are adjacencies that you might want to consider. And we put them in touch with other companies who have made this leap, right? This leap from being small and mid to large cap is a big leap. And we help companies with the transition by putting them in touch with basically the companies in the consistent compounder portfolio. And we request the CCP companies to help the companies in little champs or in rising giants make the transition. And the final piece, perhaps the toughest piece, is if we think a company is doing something which is not acceptable for our clients, perhaps capital allocation is going awry, perhaps succession planning isn't being worked upon. We sit down with them. We have a fairly tough conversation with the promoter or the CEO. We make our points of view clear. We offer our help, but we also give a timeline within which we expect to see improvements being made. If the improvements are not made in that timeline, we basically sell the stock.
Okay, let's get back to the viewers' questions now, Saurabh, and I'll ask you 2 questions, one after the other. The first one we've got is from Sameer Sinha from New Delhi, and Sameer is now getting worried about the geopolitical scenario that is upon us right now. To what degree does the Indo-Canada issue influence the Indian stock markets, and how does it really impact our investments, is what he wants to know.
I think, Samir, you're right to get worried about geopolitics, but perhaps the geopolitical issue I'd focus on a little bit more is China's implosion, because China is such a big economy, it's such a big political power, military power, such a big military power, that as the Chinese economy suffers in this manner, and every week we're seeing worrying developments on the political front in China, I think at some stage it will boil over to border disturbances, and China will perhaps take an even more aggressive stance vis-a-vis India on our northern and eastern borders. And I think that's something we need to look out for as China implodes. The Indo-Canada issue is unfortunate what's happened, but I'm not so sure there is that much scope for amplification here. I think last week itself, Canada found itself, the Indo-Canada issue, I think last week itself, Canada found itself fairly isolated on the stance they've taken vis-a-vis India. I didn't see the Americans or the British or the Australians rushing to support the Canadians. The other Western countries gave fairly tepid statements vis-a-vis Canada. So I don't think the Indo-Canada issue is going to amplify that much further. But look out for China. It's a big power, it's a big economy, and the unraveling of China at this speed is bound to have some sort of adverse impact on stability, geopolitical stability in Asia.
Okay, I hope that answers your question, Samir. The other question that has come to us is again from New Delhi. Surinder wants to know which are the sectors that I must avoid due to the rising crude oil prices now, and how is it likely to impact the market scenario going forward?
So then the crude oil prices per se, I wouldn't lose too much sleep. Crude oil prices go up and down. They're mean reverting. Oil prices typically tend to average around the $60 per barrel. And there's no point you are trying to get in and out of sectors basis crude oil. What I think you should be more careful about, what I'm telling other people to be careful about is this whole craze for buying PSUs, whether it's PSU banks or PSUs which are making defense components or PSUs which are making parts for the railways. This whole PSU theme is worrying me a little bit because the fiscal position of the government of India is reasonably tight. Tax collections this year have also been relatively weak. Budget deficits are higher than they were before COVID. And my reading is after the elections next year, regardless of what happens in the elections, I think the July 24 budget will bring about a tightening in government spending, which is bound to have an adverse impact on this whole public sector and this capex related pay, capex where railways or defense orders are being given. So I would say be careful about that more than worrying about crude prices.
Right. Saurabh, I'm glad you touched upon this two themes that have sort of underpinned the domestic sentiment over the last 3-4 months, the defense pack as well as the railway and the PSU banking sector. We've interacted over so many years, and you've clearly mentioned that PSUs are meant for the general good of the country rather than the good for shareholders. Given the rallies that we are seeing, especially in public sector banks, and the clarity that you have on their balance sheets, they don't attract you even at current levels or maybe 3 months earlier? Have you stayed away?
Yeah. So I think that they don't attract us, Shell. I think probably three sets of reasons for that. Firstly, if I look at the private sector banks, whether a Kotak Bank or an HDFC Bank, both of which are where we are shareholders, earnings growth over the last 3 years has been anywhere between 20 to 30%. And the share prices of these high quality banks have barely grown at 10-15%. And in fact, on price to book, I think on price to book, HDFC Bank is at the cheapest I have seen it in 20 years. So if I'm getting the best banks in the country at the cheapest price to books I have seen it in 20 years, I'm bound to increase my position size in those. Secondly, with the PSU banks itself, I'm seeing very stretched balance sheets. So, for example, if you take the largest PSU bank of them all, State Bank of India, debt equity ratio, financial gearing is north of 20. I think it's around 22 times. When I see a bank at that scale operating at that level of gearing, my experience tells me to be careful, to stay away rather than to get too excited about PSU banks. And the third piece, as I was saying, is we're approaching the election season, both the assembly election season and the general election season. And naturally, therefore, with interest rates high, with challenges at the bottom of the pyramid in terms of consumption, I think that PSU banks' balance sheets are bound to be called upon as we get into election season. And therefore, that's the final reason I'm staying clear of them. But I completely agree with you. This kind of wild enthusiasm, and I dare say a degree of speculation around the PSU banks, especially the smaller PSU banks, which have seen rampant share price rises in the last 30 days.
Yeah, and it must be due credit must be given to you and to your heart rate and to your pulse rate if you haven't, been tempted into buying, especially PSU banks, given the tailwinds that we've seen. But how about railway stocks, and how about the defense theme that you see? There is a very strong tailwind. I'm purposely playing the devil's advocate because, Saurabh, this is what we consistently hear from people such as yours in your peer group, that this time it's different. You have a tailwind with two neighbors who are unfriendly to India's growth story, therefore defense will do well. And we've seen a slew of orders coming in, as also the railway theme, where actually the move has come from the railway budget. So there is a spending tailwind.
Sure. No, so I can see what other fund managers are thinking here, and I'm sure there's a degree of substance to what they're thinking. So if I lay out the bull argument, I think government spending on railways and government spending on defense and government spending on roads, roughly these have grown at 30% per annum over the last three budgets, which means that broadly speaking, spending on railways, defense and roads has doubled in 3 years, right? And that means a whole slew of orders going not just to the PSUs, not just to say a BEL, but also to private sector suppliers who build roads or who supply to the defense sector or to the railway sector, right? And to add to that, payments have also gone promptly. Payments have also been made promptly to these vendors, which means working capital cycles haven't been stretched, right? Now, the reason we are staying away is the reason we are staying away is if I look at the historical track record of these companies, the companies whose share prices are roaring, the historical track record isn't much to write home about. It's not as if in the past, when they've had a bit of money, they have covered themselves in glory with their capital allocation. As we all know, the management teams tend to rotate, right? So the board of these companies tends to rotate every 2 to 3 years. So there's very difficult for them to build continuity in corporate leadership and strategy. And as I said, the most worrying thing from my perspective is budget deficits were high coming into this year, and this year, April through to July, gross government tax revenue, April through to July is up 2%. Nominal GDP growth in 1Q is up 7%, right? So on both fronts, I think there'll be a challenge on tax collections by the end of the fiscal. And therefore, my reading is on the other side of the elections, regardless of what happens in the elections, on the other side of the elections, we're bound to see a slowdown in government spending, which then has a ripple effect on these company share prices.
Okay. One more segment is what I wanted to discuss with you, and that is the new age tech companies. And because, you have said that you've not entirely convinced about these stories before. Has anything changed in the last 2 quarters when we have seen some of the companies at least reporting profits, the management commentary turning more positive on, focusing more on turning operationally positive as well? Has anything changed for you in that concept?
I mean, not really. I mean, I agree with you that these companies have become a little bit more disciplined in the last couple of quarters. I think the funding winter on the back of the slowdown in venture capital flows, the slowdown in tech spending, the funding winter, I think, has exerted some discipline on these companies, and they've tried to crunch costs. They're throwing a little bit less money at expansion, focusing on generating some profitability. But if you generate billions of dollars of GMV, and then you show me $2 million of profit or $3 million of profit on billions of dollars of GMV, I'm still not convinced you're running a business which is particularly viable. So many of the new age companies in our country, I think the basic unit economics still doesn't work. Leave aside expansion. Just at the basic unit economics level, I think they're running businesses which don't stack up, and I expect to see massive consolidation in the online space in our country, whether it's listed or unlisted. Regardless of the space, I think there'll be massive consolidation in this space. There are too many companies with weak business models. And as and when the consolidation takes place, we'll look to see companies who are able to generate healthy levels of profitability, and we'll then look to get back. Because we've also seen, right? We've seen, say, a company like InfoEdge built Naukri.com. Naukri.com makes buckets of money. And if Sanjeev Bikhchandani and Hitesh Oberoi could scale Naukri.com through the 90s and noughties, when India was a much smaller economy, and then I'm sure that the new age companies can also do the same, but it requires a different mindset, and it requires much more operational tightness than the new age companies have hitherto demonstrated.
Okay. I'll take one question from our live viewers, who are watching us on the YouTube channel. They're sending us one by one. So one question that is coming is from Hussein Arsiwala. He wants to know from you, why do companies list their subsidiaries and then merge it again with itself later? So what is the logic behind it?
I think the listing of subsidiaries is done with a view that the promoter doesn't want to dilute at the top co, at the holding co. Promoter doesn't want to dilute, so he says, "Let me list the subsidiary, get some public money at the subsidiary, which will finance the subsidiary's growth, and then when the subsidiary's growth story runs out of fizz and the share price gets crunched, then the listed holdco then buys back the subsidiary shares at at a depressed valuation. So you sell to the public at a higher valuation, and when the steam runs out of the subsidiary story, you buy it back from the public at a depressed valuation. You can figure out from that, Hussein, who's the person laughing all the way to the bank here.
Absolutely, and it's not the retail shareholder, if I may add. Saurabh, sticking with the digital theme, we've seen a major milestone happening in India, which is 10 billion transactions per month in the UPI zone. I remember your very good interaction that you had with Mr. Nandan Nilekani, which you spoke so evocatively about in the public space. Is there a catchment there of companies that will do really well over the next 5-7 years, given that this is real business being transacted? And do any of such companies form a part of your overall investment in these 5 PMSs that you offer?
Sure. So look, I think the biggest beneficiary of the India stack and the biggest beneficiary of the fact that the cost of transacting, the cost of borrowing, the cost of investing is being crunched. The biggest beneficiary is the financial services sector, not just lenders, but even insurers, asset managers. I think the whole go-to market, whether it's an insurer, whether it's an asset manager, whether it is a lender, the cost of going to market has been crunched quite deeply in our country, right? So our investments, not just in HDFC Bank, but Kotak Bank, but also say Bajaj Finance. Bajaj Finance is a massive beneficiary of this. Similarly, ICICI Lombard, HDFC Life, the whole ability to sell cost efficient, high quality products with low distribution cost, I think has increased dramatically. In the wealth management space, in the smaller ticket wealth management space, in our small cap portfolio, Little Champs, we have investment in a company called Prudent Corporate. They sell mutual funds and insurance to low income people, 5 lakh, 10 lakh, 20 lakh people who can invest in those sorts of ticket sizes. So that's the first big constituency that benefits. I think this at a second remove, as a second step, the beneficiaries are, say, companies selling jewelry or cars. So, for example, if you go to any car dealership today, you can see that the car dealership is able to offer loans to almost any customer from that customer's bank in as little as, I think, a few minutes. So whether it is Saurabh Mukherjea buying a Maruti, or Sakshi buying a Maruti, or Shail buying a Royal Enfield, at the dealership, whichever bank we are with can offer us a auto loan in the space of a few seconds, at most a few minutes. So from the perspective of vehicle purchases, whether it is a Royal Enfield purchase or a high-end car purchase, the cost of buying, the cost of transacting, the cost of taking a loan is crunched down to a few seconds, courtesy the India stack, right? And the third layer is tax collections, right? Because the whole India stack piece, whether it's the chai wala being paid through UPI, or whether it's my auto rickshaw driver getting paid through UPI, the whole piece, the whole transactional piece, I think 51% of GDP is now done through, is transacted through UPI. It's difficult to evade taxes on that. It's difficult to evade taxes if you're transacting through UPI. It is by definition a wide transaction. This bodes well for India's long-term tax buoyancy.
Okay, so 2 things are very clear. Saurabh is not going to buy a Maruti, he's going to buy a Merc. And I think I have made up my mind to again look very seriously at my 4th Royal Enfield. That should happen. Just to put on record, I have been a very, very long-term holder of Eicher Motors. So one should be very happy.
Not a Harley, you wouldn't be tempted with the Hero Harley.
No. Harley has a problem in India, Sakshi, which is that their engines are not liquid cooled. So in a city like Delhi, at 45 degrees on the road, the Harley is actually at 60 degrees. So it's very, very painful to drive a Harley at any time before, after 10 a.m. to 4 p.m. in Delhi. But as Saurabh said, let that be a part for some other discussion. Saurabh, now let's come to the remaining 2 questions in our valuation metric. You've isolated a stock, you've spoken to the management, you've helped them out. Now, how do you track your investments? Is it a weekly con call that you have amongst your 15, 16 analysts? It's a monthly check that you do. Of course, you watch quarterly numbers and whatever has changed in the peer group as well as the company. How do you do the nitty-gritties of sort of tracking that investment?
Sure. So let me just explain through a quick example. So for every stock in our portfolio, we have a recommended position size basis our view on the fundamental valuation of the company. So let's take a company such as Divi's Lab, right? So Divi's Lab, going into COVID, our view was going into COVID, say back in March 20, early days of COVID, our view was this should be roughly 3%, 4% of our portfolio. Then, as the stock rode through the first 2 years of COVID, the stock's weight kept going up. It kept pushing north of 3-4% because Divi's did so well in those first 2 years of COVID. Our view was COVID was not going to last, and therefore every time Divi's rode up, we would pull the weight back to 3-4%, and that's something that's tracked weekly by our fund managers. That if Divi's is pushing north of the recommended weight of 3%, we will pull the position back because we didn't think COVID would be a long-term driver of Divi's compounding. Then by the time we came to January 2022, Divi's was down to 2% of our portfolio, which we felt was where it should be given the long-term prospects of the company. However, through 2022, Divi's share price halved. As COVID ended and Divi's told the world that Molnupiravir revenues, which were COVID-linked revenues, are ebbing off. Through 2022, Divi's halved, and by the end of 22, Divi's position size was, I think, down to 1.5% of the portfolio. That's when it became apparent. The whole China tensions emerged in the latter half of 2022. And November, December, we did some work talking to Divi's customers, talking to the global pharma majors in their American headquarters. November, December, we became convinced that there was going to be a big shift from China to India in API production. So January of this year, we quadrupled Divi's weight from roughly 1.5%, 2% to 6-7%. Right. So that was a strategic call made that, look, Divi's has done well through COVID. The position size had been reduced through the COVID years. In 2022, the stock has halved, but now the market is misunderstanding Divi's positioning. It's a major beneficiary of China plus one. Let's ramp up the position size. So Jan 23, we quadrupled Divi's position size in the portfolio. And now as Divi's goes up, if it goes through, say, if its weight increases north of 8-9%, we might think of paring the weight back, but we think Divi's stands to be a major beneficiary of the tensions that are playing out across the world, especially in China.
Okay. Saurabh sir, I wanted to understand from you, since we've been talking about this entire consumption spree right now, and we are sitting right ahead of the festive season this time. It's going to be an elongated one along with the wedding season. If I may ask, do you have anything lined up for your shopping basket if the markets were to correct any further from here? What are you going to be buying?
I mean, look, I try to keep my shopping to a minimum. I think I've always found it better to invest in Marcellus's portfolios than to go and invest in shopping. But jokes apart, we've got a nice pipeline of companies that we are researching on for the next month or so. These companies are basically plays on three themes. The first theme is what we started our discussion with, the rise of the super rich in India. We think the super rich will have a blast this festive season, and we're lining up some investments to make money as the super rich in India keep spending money. The second is the economic boom in South India. The China plus one play, the rise of the GCCs, global capability sectors, the rise of iPhone manufacturing, etc. This disproportionately plays out in southern India. So we're targeting some investments which are South India centric. And the third is the rise of Indian women. Indian women are now earning more than Indian men in many sectors. We have solid data which suggests Indian women have more money in the bank than Indian men, significantly more money in the bank than Indian men. And as the Indian economy becomes more high tech and more services centric, this economy will tilt even more sharply towards women, because women are studying more and passing more exams than men are, and that means their economic power will grow, and hence we are targeting companies that are a play on women spending rather than male spending.
Right. Males never get to spend as much as they like. Saurabh, it's on bikes and cars that our love is sort of spent, and they are depreciating assets. You are nodding very sagely, and I understand how deeply it's felt at your end. Same here. But coming to this woman-centric investment theme, what are the stocks that are represented from that zone in your 5 portfolios?
Sure. So I think we already discussed Rainbow Hospitals. Let's discuss a straightforward one, Nestle, right? Nestle is a out-and-out play on women spending. And if you notice what Nestle's management has done over the last 3 years, it's very clever. They have further premiumized their infant milk powder product, right? They've created a premium version with a golden ribbon saying this XYZ formula has mother's hormones in it, and that product has done very well. They've also bought from the Western world their fruit puris. There's a brand called Gerber, Gerber. This is a crushed fruit for infants. It's an expensive product, but Nestle has announced they're going to launch it in India. So I think Nestle will be a straightforward play on women spending more on their infants. Similarly, if you look at Trent's West Side offering, which is focused on, say, middle class people, has done really, really well over the last decade or so. Over the last 3 years, Trends has launched this more economy offering called Zudio. It was launched 5 years ago. It's really taken off. Zudio has really taken off in the last three years. The bulk of Zudio's branches shall have come up in South India, and the inventory turns, the rate at which clothes are flying through these Zudio retail outlets is 10x more than what we have seen in any other apparel retailer in the country. So West Side generally, but increasingly Zudio is a play on youth spending, specifically women-centric youth spending. And you wouldn't be surprised to hear that the bulk of Trend's expansion has been focused on South India. We've already discussed Titan. Carrot Lane is growing at twice the rate of Tanishq. Tanishq was 80,000 rupees ka jewelry. Carrot Lane is around 20,000 rupees jewelry. The professional woman who starts work is a natural target for Carrot Lane, and no surprises that as more women start work, Carrot Lane is growing at 50% per annum as opposed to Tanishq's 25% per annum.
And that's probably the reason why Titan recently bought out the entire stake that Carrot Lane promoters held, and it's now a subsidiary of Titan. Correct me if I'm wrong, Saurabh, when I look at your valuation matrix, you're basically looking at companies that have 12-15 year of quality performance, which is backed both by stock price as well as the balance sheet. And the fact remains that you hold them for probably forever. But there comes a time in the life of all stocks and all portfolio managers where you underperform the market for various reasons. The market may be running up on sectors which are not found in your portfolio, or there may be some theme running into the market which is unrepresented in the PMS. So how do you pass that time, and how do you convince your investors to keep the money with you simply because over the last 18 months or so the market has not favorably looked at your long-term purchases?
Sure. So look, I think when we started out, Marcellus, we knew that in a typical 5-year cycle, 1.5, perhaps 2 years, we wouldn't be able to play the capex cycle. The capex cycle is typically where investment styles like ours somewhat get left behind. So Jan 22 is when Russia invaded Ukraine. Within a few weeks, the price of oil had doubled, the price of metals was up 50-60%. And through 2022 and the first 3 months of calendar 23, so basically Jan 22 to March 23, our flagship portfolio consistent compounders fell by 15%, whilst the broader index, I think, rose 7 or 8%. The broader index rose because oil marketing companies, metals and mining companies did extremely well. And as the broader index rose, we fell. Obviously, lots of clients called up to say, what's happening? Why is Marcellus underperforming? We explained this point that, look, we have no ability nor any desire to participate in rallies in oil stocks and metal stocks. We would rather stick to what we know best, which is clean, high quality, well-run companies. And astonishingly, Shell, 95% of our clients stayed put. 5% redeemed and left, which is only fair. If you want to outperform in a rally driven by oil stocks and metal stocks, we in Marcellus really can't help you. 5% redeemed and left, 95% stayed. In the last 6 months, those who stayed have been richly rewarded. In the last 6 months, consistent compounders is up 20%, the market is up 14-15%, and we are back to business as usual. We're investing in companies whose profits are growing pretty consistently at 20%. In 3 out of 5 years, that seems like a great idea. in 2 out of 5 years, that doesn't feel like such a good idea, and we are happy to stay the course, stay invested in this group of high quality names, knowing full well that some years we will underperform, and we've tried our best to communicate that to the client base, that you won't have a fund manager who will outperform every year in a typical 5-year economic cycle.
Perfect, and I understand this intuitively. Even if you look at what Warren Buffett says, is that you should look at consistent 5-year and 7-year returns rather than outperformance in 1 or 2 years. But that point very well taken, and perhaps those.
And if I could just
yes, sir.
interject there, over the 5 years, we have beaten the Nifty handsomely.
Yes.
Net of fees, we've beaten the Nifty handsomely. And as the sage from Omaha has pointed out, in half the months, Berkshire Hathaway underperforms. In half the months, Berkshire Hathaway stock underperforms, and yet over 50 years, nobody has made as much money as the Berkshire Hathaway shareholder.
Absolutely, I agree with you in totality about long-term passive holding and watching paint dry as being your investment mantra over the long term. Saurabh, in this excitement of asking you all the basic questions on how you pick up a stock, how you hold it and nurture it, I forgot the basic question. Where is Nifty headed over the next 1 year?
So look, at the index level, it's hard for me to make a call here. The reason I'm hesitating to make an index level call is twofold. Firstly, we are at a juncture where not only are global interest rates the highest they've been for nearly 30 years, it's not apparent to me that global interest rates will fall in a rush. And the second reason I hesitate is we've got a very busy election calendar, both assembly elections and general elections, and therefore I'm hesitating to make a call at the Nifty. But let me give you two sort of sets of insights which might be helpful for your viewers. If I look at the consistent compounders, earnings compounding over the last 2 years has been 20%. Earnings compounding has been 20%. Share price compounding for the consistent compounders, names like HDFC Bank, Kotak Bank, Divi's Lab, Asian Paints, share price compounding has been the vicinity of 6-7%, right? So you've got clear valuation gap opening up there, high quality names, profits growing at 20%, share prices growing at 6-7%. In contrast, names in the metals mining sector, in the PSU space, in the oil marketing space, it's been the other way around. Historically, these companies have struggled to generate free cash flows, and yet over the last 2 to 3 years, their share prices have been on a tear. So within the Nifty, I think there is a overvalued spot and there's an undervalued spot, and I suspect at some stage over the next couple of years, the overvalued companies will come back to earth, the undervalued companies will rise, and that's the sort of investment construct around which we are basing our investments.
Fair point. The reversion of mean is one of the underpinning philosophies of great bull and bear markets, and typically sectors rise and they fall over a 2-3 year period. The point is, when do you get in and when do you get out? Sort of my final question. Is there a certain number of stocks that one should not go beyond in any kind of a portfolio for it to always remain young, always compound, and maybe give stellar market beating returns?
Sure. So look, from finance theory's perspective, finance theory says that the minimum number of stocks you should have in your portfolio is 14, 15. That finding goes back 50 years to the economists in Chicago. In the practical Indian context, I have found it very difficult to manage portfolios with more than 25, 30 stocks. There simply aren't that many strong compounders in India that you can run a stock with 40, 50, 60, 120 names. Some fund managers do it. I have huge admiration for them, but I've always wondered, how do you build an Indian portfolio with more than 25, 30 stocks, given the paucity of clean, high quality compounders in India?
Does that mean that over the 5 portfolios that Marcellus offers, there is a commonality and the total number of stocks would probably be somewhere like 40, if not less?
In fact, it's less. So across the 5 portfolios, there is commonality, and the total number of stocks we offer is around 34, 35.
Wonderful, Saurabh. It's been a very, very enjoyable 45 minutes. Thank you so much for your time. And it's been such a illuminating journey to understand how your brain works when it comes to picking up stocks and avoiding sectors which offer little or no enthusiasm for long-term investing. Thank you so much for your time, and I hope that the outperformance that you've seen over the last 4 or 5 years gets compounded magically over the next 20. Thank you so much for your time, sir.
Thank you.
Thank you so much, Hel. Thank you so much, Sakshi. Thank you.
Thank you.
So that, ladies and gentlemen, was Saurabh Mukherjea for you. This was a very different kind of Market Masters where we tried to do a show which will be relevant even 15, 20 years from now as to how to pick a stock and how to remain invested in what possibly would be a great multi-bagger in the coming years. Thank you so much for your time, and I hope you really enjoyed this presentation. Please remain glued to Business Today Television for all your stock market requirements and needs. Thank you.
The Investigation Division of the Central Board of Indirect Taxes, the Directorate General of Goods and Services Tax Intelligence, has reportedly uncovered an alleged tax evasion of nearly 31,000 crore rupees by online gaming companies. Sources have informed Business Today that the centre is currently in the process of issuing show cause notices to these gaming companies that have failed to pay taxes. Karishma Sudani has the story. Karishma, take us through what you've learnt from your sources, especially as this surfaces so close to the 28% GST that's going to be in play from the 1st of October.
Well, right, Abha. In fact, it comes closer to the date that you have mentioned, and we are picking up exclusively from our finance ministry sources that as per the current investigation, they have ascertained that close to 31,000 crore evasion tax